Hey guys, it's Nick, and in this video, I want to talk about some of the signs that we are in a stock market bubble and heading for a stock market crash. Now, one of the surest signs of this is when everybody and their mother is only talking about stocks that they buy and how much they made and cryptos and this and that, and how everybody thinks that or dreams that they are going to just sit home or sit in a coffee shop or sit on the beach on their phone and just make a few trades every day and make millions of dollars. Not only that, but they think they're going to do that from a small account, like $1,000, $5,000, $10,000, and that they are just going to make 1,000% or more every year going out 10, 15 years, even though hedge funds with all the PhDs and programmers that they have and all of that stuff only make maybe 10, 15, 20, 30% a year. But the people that think that they're going to be on their phone making 10 times their money every year is usually the sign of a top. So let's take a look at what's going on now and how it compares very closely to what was going on in 1999 during the internet bubble. This article is about how Gen Zers are taking on debt to invest in the stock market. And I don't just mean margin accounts at their brokerage. They are borrowing money and then putting it into their brokerage account and then taking margin on top of that, or maybe buying options with that. So really leveraged positions. Now, Barron's had an article about GameStop's wild ride, and it highlights the newfound power of individual investors to target vulnerable stocks and make quick profits. And their goal, use Reddit and other social media to outfox Wall Street. So the people that are just now getting into this are thinking that this was never done before. This is something completely new and it's different this time. But if you look at this article on the front page of Forbes, this is from the late 1990s, and it says a bunch of kids are tormenting Wall Street. High-tech renegades score big bucks by making their own NASDAQ markets. And this is basically when the Island ECN came out and you could put your own bids and offers on the NASDAQ level 2 screen and basically be a market maker, or some people thought. Now, back then, Jim Cramer was the market guru, and he had this Winners of the New World, years 2000. And this is the price of them then when he mentioned them. And this is how much they lost in the following years: 99%, 74%, 94%. And this is the annual equity inflow since 2002. And 2021 is annualized year to date is 1.2 trillion, huge compared to all of these other years. So everybody is just jumping into the stock market thinking that they are all going to get rich. And here's a chart of margin debt and free cash balances. And you see margin debt is the highest it's ever been, and free cash balances, meaning on average, the total amount of free cash in people's brokerage account is at the lowest. So everybody is all in. They have no cash in their accounts and they have huge margin debt. So they are basically betting the farm on everything. And you see how well that works. During the dot-com bubble, the cash balances were at their lowest, the margin debt was at their highest, and that turned around very quickly. Same during the great financial crisis, the cash balance was at a low and margin debt was at its high at the peak, and then that reversed itself. But here, these numbers are like historical, off the charts kind of numbers here. So this doesn't usually end well. So, but with margin debt, you could only borrow 50% of the account's value. So what do people do when they want to bet even more? They go and borrow money, take loans, borrow from family and friends and things like that. So this is a survey of 994 investors conducted March 30th to April 6, 2021. Have you taken on debt to invest? And overall, 40% said yes. The Gen Zers, 80% did. Millennials, only 60%. Gen X, 28%. And baby boomers, 9%. So looking at this graph, it looks like a good example of the Dunning-Kruger effect, where people who have the least knowledge are the most confident in their knowledge, and the people that have the most knowledge are the least confident or underestimate their knowledge. So you see the Gen Zers that have very little experience in investing, they are 80% in. And so the older you get, the more experience you have and the less money you're borrowing to invest. So the baby boomers have the most experience. 9% of them are borrowing money to invest. And this is a look at the Dunning-Kruger effect. And so when you know nothing over here, your confidence is really high, and they call it the peak of Mount Stupid. And as you start to learn, you start to realize how little you really know. And the more you learn, then you start getting into the slope of enlightenment and the plateau of sustainability. So these are the Gen Zers, and these are kind of the millennials, and here is the baby boomers. And here is the original article on Magnify Money, and 38% of people that took on debt to invest took out a personal loan. Some 23% borrowed from friends or family. 14% went into credit card debt, and 13% withdrew or borrowed money from their 401k. It's got to be really hard to borrow money from your friends and family that you then put into a brokerage account and margin up in the hopes of making money. Because if that thing turns around, you're going to have a hard time facing your friends and family when you can't pay them back. And so the amount of debt consumers took on, 26% were between $5,000 and $10,000, and 20% were $10,000 or more. So for those people that think that this time it's different and that this free trading on your cell phone is a whole new paradigm shift and all this stuff, and because of Reddit and social media where people can work together and get rich and all this stuff, and it's different this time because of that. Well, I'm here to tell you it's not. And let's look at this article from Forbes, January 25th, 1999, a few months before the internet bubble popped. So they always start with somebody who's making money. Nancy Sis is a 42-year-old credit specialist, blah, blah, blah. 1997, she started buying web stocks through E-Trade using tips from the Motley Fool website. In 2 years, she increased her portfolio from 39,000 to 100,000 plus by investing in stocks like Amazon.com, America Online, and eBay. This morning, I bought 200 shares of AAGP at 14 and sold at 19 3/8. This is when they traded in fractions. Last month, I bought Books A Million at 16 and sold at 26. Now, for those that don't remember, Books A Million was the poor man's Amazon. It was the runner-up to Amazon. When Amazon got too expensive, people went and bought Books A Million, saying that they're going to be just like Amazon. Now, see if this kind of talk sounds familiar with you and your friends. I used to idolize Warren Buffett, but now I follow the message boards. Over the next 5 years, she figures she can grow her nest egg by at least 25% a year and become a millionaire. Well, that's chump change by today's standards. People want 25% in a day. This guy, Nicholas Burbas, 25-year-old former waiter from Queens. Hey, that's where I'm from. Has a 300 megahertz Pentium laptop patched into E-Trade via America Online. Oh my God. With these tools trading in and out of stocks like Navar, I remember that one, and Netscape, he turned 1,100 into 100,000 in 2 months. Before, I was investing for the long term, and I found out that it was not smart. Now my goal is a 1,000% return by 2000. So in 1 year, he wants to make 10 times his money. Yes, the stock market has seen plenty of speculative bubbles before, but this one is different. Each day, a 5 million strong mob of online investors is proving that when it comes to stock picking, might makes right. In their world, everything you have learned about rational pricing, earnings, or book values, or even revenues is meaningless. Don't worry about the long haul. Trade for the moment, make a killing. Hey, everyone else in the chat group seems to be doing that. All you need to change from chat group is TikTok or Reddit, and it's the same thing. The new era has captivated even some of the pros. I am not so sure this is an ignorant mob, says Robert Lessin, former vice chairman of Salomon Smith Barney and now chief executive of the tiny online investment bank Wit Capital. These internet users may be the most knowledgeable people around to value these franchises. And just how they say that there's power in numbers with the Reddit mobs and all that, well, here they say, like any mob, the online traders get their power from sheer numbers. And so they say, for one thing, online investing is cheap and easy. Fast, powerful, personal computers cost little more than a television set these days. So replace powerful personal computers with cell phones, and this is the same thing. There are now some 100 online brokers offering executions at as low as $5 per transaction. And so, yes, these low execution prices like Ameritrade at $8 and Daytech at $10 really had trading exploding because of that. And you're seeing the same thing now with the free trading. Don't worry about the long haul. Get that real-time price feed. We're all getting rich. I cannot wait to get up in the morning and trade. This is the most exciting thing in the world for me right now, exclaims 51-year-old personal injury attorney Barry Plotkin. Plotkin spends several hours a day trading from his laptop while sitting on his front porch looking out onto San Diego Bay. Last April, he took out a $300,000 home equity loan and began online trading through Waterhouse Security. He first invested in stocks like Home Depot and Walgreens, but became bored. Then he turned to stocks like Amazon and Yahoo. And see if this sounds familiar, what you're hearing from people trading today. My philosophy is to buy high and sell higher and not be afraid to take risks. I use no research tools or software. I just surf the message boards and look for volume, Plotkin says. He predicts that with help from his computer-savvy 26-year-old son, Robert, he can build his nest egg to $15 million by the time he reaches 60. Investors these days don't just dream of getting rich, they expect to get rich. And so according to this recent survey, the average investor expects an annual 18.6% rate of return on stock and stock fund portfolios. And historically, just before the crash of 1929, investors expected an annual return of 10%. So these days, investors seem to expect, 30%, 50%, 100%. And for people who think, yeah, well, they didn't have GameStop and short squeezes and all that stuff going on back then. Yeah, they did. Let's look at this. Consider what happened to one of the most successful short sellers of the last 40 years, Meyer Berman of Boca Raton, Florida. Berman's world had been turned upside down. He shorted Zytel, a software company that has a stake in a company that makes software that fixes Y2K problems. Berman checked the company out and figured it was worth a dime a share because industry experts were convinced that its automated system didn't work. However, without any significant news, the e-traders helped move its 6 million share float from 10 to 145 in a matter of months, squeezing shorts like Berman. And so the online mob has given legitimacy to a new crop of web opportunists. And what it is these companies that were regular companies, they now came out and said they had a website, and now their stock started trading like an internet stock. So take Greg Manning Auctions, a sleepy New Jersey collectibles and stamp auction house. For years, the stock languished at less than 2. So at the end of October, Manning announced that he would buy a small web company and hired a public relations firm to tout it. Manning's stock rose tenfold to $20 per share within a few days. But not everybody was permanently bullish. Look at this. Yes, the caution flag is out. Bernard Madoff, yes, that Bernard Madoff, the biggest Ponzi scheme in history, is head of the market-making firm Madoff and Company and also chairman of the trading committee for the Securities Industry Association. He's urging online brokers to tell their clients that highly volatile stocks like Amazon and Yahoo are likely to face a severe lack of liquidity during a downturn or a prick in the internet stock bubble. The problem is there's no buffer between the customer and his own tools of self-destruction. Wow. So what he's saying is don't destroy yourself by trading stocks by yourself. Put your money with me and I'll destroy your money for you. Thanks a lot, Bernie Madoff, for those sage warnings. So guys, I don't know when this bubble is going to burst. It could go on for a little while. It could go on for a week. Who knows? But Protect yourself. Don't do crazy things. Don't take out extra debt just to margin it up, or even worse, leverage it up with options on short dated options or something like that, because eventually you will go bust when things turn sour. Now, a lot of people are not going to be able to resist the bragging from their friends about how much they're making. And so they're going to have FOMO and really leverage up and go all in on whatever hot stock is going on at the time. And so I know a lot of people out there are hoping they are like this guy in this E-Trade commercial back in 1999. Check it out. So everybody has dreams of being this guy.
Oh. Oh.
Stock goes up. Tell your boss, screw this place.
Hey, Mr. Dinky's busy.
Hey, Dinky, I quit.
Except a lot of times this eventually happens.
Oh, no. Oh. Mr. Dinky, I'm not quitting. That was a joke, sir.
So there you have it. Don't think you're going to get rich from just having a little bit of money and just taking really highly risky leverage bets. It usually ends up badly. If you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.